As the 2024 presidential campaign trail heats up and inflation slowly trends downward, the Federal Reserve appears set to resist growing political pressure, particularly from former President Donald Trump, to slash interest rates. With inflation still hovering above the central bank's 2% target and economic indicators showing resilience, the Fed is signaling a cautious approach, prioritizing stability over stimulus despite Trump's aggressive rhetoric pushing for rate cuts. A political flashpoint: Donald Trump has made the Federal Reserve a frequent target in his renewed campaign for the White House. As inflation cools and the economy shows signs of moderation, Trump has called for immediate and substantial interest rate reductions, claiming that high borrowing costs are stifling growth, hurting working-class Americans, and sabotaging economic momentum. At recent rallies and in social media posts, Trump has gone further, accusing the Fed of trying to sabotage his political comeback. The Fed is keeping rates high to make things worse so they can help Crooked Joe, Trump stated at a rally in Ohio, referencing President Joe Biden. They're not independent, they're political. However, the Fed, under the leadership of Chair Jerome Powell, has repeatedly emphasized its independence and commitment to long-term economic health rather than short-term political calculations. Inflation, still sticky, though inflation has cooled significantly from its 2022 peak, core inflation excluding food and energy remains sticky. The Consumer Price Index, CPI, rose 3.3% year-over-year in June, a slight improvement from previous months, but still above the 2% goal that the Fed has consistently cited as a benchmark for any significant policy shift. Fed officials are cautious. In multiple statements, they've reiterated the importance of sustained progress on inflation before considering any rate cuts. We're prepared to hold rates steady for as long as needed to bring inflation back to target, Powell said. At a recent press conference, we don't base decisions on political cycles. The Fed's benchmark interest rate currently sits between 5.25% and 5.5%, the highest level in over 2 decades. These levels have helped slow inflation, but have also dampened consumer borrowing and business investment. Despite the pressures, Powell and his team remain committed to a data-driven approach, resisting politically motivated calls to ease policy prematurely. A strong labor market adds complexity, as the complexity is the strength of the labor market. Unemployment remains low at 4.0%, and job creation, while slowing, continues at a steady pace. Wage growth, though moderating, is still above pre-pandemic levels. These metrics complicate arguments for rate cuts. With a robust labor market, the Fed sees little immediate need to inject additional stimulus through monetary policy easing. This resilience undercuts Trump's narrative that the economy is on the verge of collapse. Economists note that while higher rates pose challenges, particularly in the housing and auto sectors, the broader economy has not contracted in the way some predicted. In fact, GDP growth for Q2 stood at a healthy 2.1%, signaling that the economy remains on solid footing. Trump's influence echoes of the past. This isn't the first time Trump has clashed with the Federal Reserve. During his presidency, he frequently berated Powell for not cutting rates quickly enough, especially in the lead-up to the 2020 election. His administration publicly floated the idea of firing Powell, something that drew backlash from economists and lawmakers across party lines. Trump's current push to politicize the Fed again raises concerns about central bank independence. Analysts warn that undermining the Fed's credibility could lead to volatile markets and long-term damage to economic governance. Markets need to believe that the Fed is insulated from political pressure, said Mark Zondi, chief economist at Moody's Analytics. If that trust erodes, inflation expectations could become unanchored, and monetary policy becomes far less effective. The 2025 outlook: timing is everything. Most Fed watchers agree that the central bank is unlikely to cut rates before late 2025, unless there's a marked deterioration in economic conditions. With a presidential election looming, any rate cut close to November could be perceived as political, even if based on economic data. This puts Powell and the Federal Reserve in a delicate position. Traders are currently pricing in a 25 basis point rate cut in December, according to CME's FedWatch tool, but that expectation fluctuates with each new data release. A hotter than inflation print, strong jobs report, or political instability could delay any policy shifts. Biden's silence, Fed's focus. Interestingly, while Trump has been vocal, President Biden has largely refrained from commenting on monetary policy, respecting the tradition of keeping politics and the Fed separate. This silence highlights the administration's trust in Powell, who was originally appointed by Trump and later reappointed by Biden, further emphasizing the bipartisan support for the Fed's independence. Meanwhile, the Fed's focus remains squarely on the numbers. With each Federal Open Market Committee FOMC meeting, officials are scrutinizing inflation, wage growth, consumer spending, and global economic headwinds. The message remains consistent. Rate cuts will come only when the data warrants them, not when politicians demand them.